Ladies and gentlemen, in front of your eyes, the Compound and Friends live from the Alamo Drafthouse with your host, Josh Brown. Let's have some fun. Michael Batnick. And their special guest, Brian Belski. Give it up for the Compound and Friends live.
Let's go, let's make some noise in here. All right, ladies and gentlemen, thank you so much for being here. We had so much fun planning the show. We spent the last 2 days in Naples. We absolutely love it here. If you're a local, make some noise. Let me hear you. All right, and if you flew in here or drove here from somewhere else, make some noise. Let's hear it. Okay.
So Brian was clapping. This is a home game.
Brian I don't know if you know this, Naples, most of the time resident?
Most
would
of
you
the time.
say?
Seven months out of the
And
year.
it's a home game for me, too. This is my favorite theater in the world. Shout out to Alamo Drafthouse. Let's go.
And guys, you are in for a treat. This is a really exciting time in the markets. We got off to a rock and roll start. And today was quite an exciting day. And we're going to get Brian's take on what to make of the momentum sell-off. We don't know if it's short-lived or a sign of more to come, but we absolutely are extremely lucky to have Brian here. Before I read you his official introduction, I do want to thank our sponsor, Public.com and the Public Trading app. Public has been an incredible sponsor for the Compound and Friends. We know a lot of you guys have tried out their app, their website for some of your own trading. So let's make some noise for Public. And I want to just level set the room for a moment, just so Brian has an idea of who's in attendance. If you are my generation, Gen X, make some noise. Let me hear.
Oh, wow.
Okay.
All right.
Okay. Michael's generation, Generation Y, millennials.
No, millennials. Let's go. Let's go.
Okay.
Gen Y.
Brian's generation, the silent generation. Okay. Just the trophy wives, the Naples trophy wives. We have a few? Okay. All right. Ladies and gentlemen, Brian Belski is the chief investment strategist and leader of the investment strategy group for BMO. Brian, we say BMO.
Say BMO.
BMO. Brian has held various senior strategy and research roles, including positions at Oppenheimer, Merrill Lynch, and Piper Jaffray. Brian also oversees 10 actively traded equity portfolios and 2 quant ETFs for U.S. and Canadian wealth clients of BMO. How long have you been there now?
13 years, 3 months, 4 days, and 12 hours.
Okay. All right. Brian, the last time we had you with us was May of 2024.
Yeah, I thought you broke up with me.
No. The S&P 500 is up 17% since then. And of course, one of the things that you're most known for was having been bullish the entire way up. And now it seems easy to have ridden the market all this time. But in the moment, at many of the moments at which you joined us on the show, you were kind of a voice of hope in the darkness. And yeah. I think you've been that for investors, but institutional investors, retail investors, I think for a great many years. And we're very thankful to have access to you, be able to speak with you in those times. And I couldn't think of a better person to be talking to right now. I do want to remind people what you said when you were with us last spring. Our call, this is Brian's words, our call remains resolute. 25-year secular bull market. Within secular bulls, you can have cyclical bears and cyclical bulls. We are in year 2 of the cyclical bull that started in October of 2022. We need some sort of a pullback. There's never been a bull market in the second year that has not had a pullback more than 5%. We ended up having one that summer.
Right after the show.
Almost immediately after he spoke.
And Brian said you said you were scared shitless. Do you remember that?
Yep.
Because everything was going your way.
Yeah, I mean, I think, thanks a lot for reminding me of that. No, but I think in this business, in this world, you have to be humble. And I always, not to get too preachy on you, but before I always do anything publicly, I always quote a Bible verse in my head: "Act justly, love mercy, walk humbly." So when things are going really, really good on stocks, Mike, I literally shit my pants because I'm thinking something's going to happen. Figuratively.
Yeah, not literally.
Well, and I'm so worried because things are going so well. And that was one of those times in last summer. And thankfully that we rode the storm out and we had an amazing year performance-wise for our portfolios. But I think we kind of, that's part of the reason why we've been known to think a little bit differently than most strategists, because we actually run money and we have long-term positions and we have 10 different strategies, and we just crossed 10 billion AUM at the beginning of this year. Now, obviously a little higher for our performance. So we're very blessed to do what we do, but it actually, when we're doing really well is when I really, really get worried. When we're not doing very well is when we can pull up our bootstraps and really, really defend our process and discipline.
Can we double click on that? You run money and most of the other strategists do not. They advise clients of the bank. They talk to financial advisors. They talk to institutions. You do all of those things, but also you manage portfolios, and you see that as an edge.
I do. And, when I first came to BMO, I started doing this at Merrill Lynch when I took over the Chuck Cloud portfolios. They were known as the client profile portfolios. And Merrill was worried, and then all my subsequent jobs since then were worried that a portfolio manager, say at JP Morgan or Morgan Stanley or Fidelity, would be worried that I was competing with them. But actually, they really like it because I kind of think and act and feel like they do from a positional standpoint, and I'm living and dying with positions, and we talk a little bit more of that. Now, obviously, a big mutual fund manager, at that type of shop, manages money very differently than I do, meaning 150, 200 stocks. We have usually 50 stocks, so we're more concentrated, and we have very, very low turnover. But I have 3 jobs at BMO. So I forecast the U.S. stock market, which I have as the person at the top of the piece of paper since 1998. I've forecasted the Canadian stock market since I got to BMO in April of 2012. And then I also do portfolios. The majority of people that you have on or talk to, really amazing strategists, they have one job. And all they do is they talk to everybody, hedge funds, to professional money managers, they travel the world, they have global clients. They talk all day long about their view on the market usually. And I was schooled under the adage of, I'm kind of like Bill Murray said in the movie Stripes, I'm the last of a lost generation of strategists, that I look at stocks and how they fit into industries and sectors in the market. I think the majority of my competitors, quite frankly, only look at the market and they just want to make these big market calls. And I think that actually has added to the volatility. Number one, it's actually helped me do my job a lot better.
How many people are still in the same seat since 1998, the way that you are, in that strategist role that started at the same time as you? Almost none.
Michael Goldstein, but he was at Bernstein at the time. Now he's got his own shop, and I think he's retiring. Ed Yardeni was obviously in the biz then. We lost recently. Tobias Lefkovich was the other person that's been doing it that long, Citigroup. But I'm the longest standing senior strategist or top of the piece of paper strategist on Wall Street.
That's pretty wild. You want to get into the fund manager survey?
So, Brian, you love to talk about what your competitors are thinking about, talking about, and for people in the audience and for people listening, there's so many contradictory, I don't even call them signals because they're not signals, just noise in the market. So, for example, we have the fund manager survey that Bank of America does. Is this quarterly? How often?
I think it's monthly. It's monthly.
And so here's the latest. U.S. equities seen historically overvalued by 89% of investors surveyed. 89%, okay? In the decade to date, an average of 81% of fund manager survey investors have consistently viewed U.S. equities as overvalued. For the last decade, a historic bull market of 15% compounded, 81% of the time they say they're overvalued, U.S. equities. But then you also have on the other side, they do how much cash do you have in your portfolio? So how is it possible, or why is it possible, that the same people who say the stock market is as overvalued as it's been ever, basically, have only 3.5% of their portfolio in cash, which is basically
the lowest on record.
The lowest on record.
So you've got like an ocean of people saying stocks are overvalued, but they're all fully invested.
Yeah.
Well, the answer to that is a couple things. I used to work at Merrill Lynch, so I kind of know how that was. In the old days, you didn't have a lot of U.S. investors answering that fund survey.
Wait, hang on. Come on.
No. Here's the deal. Mike, when you get a survey, do you fill it out?
No, never.
Okay, exactly. So that's number one. Number two, this is how you judge somebody. And this is where the millennials, and I call them the Gen Zers, the Zers, they are
We got
SOL. And here's why. They had the thing called the vid. Nobody knows how to talk to each other anymore, look anybody in the eye or shake hands or talk, whatever. The greatest gift in this business is marketing and sitting across the table from somebody and know when they're lying to you, okay? Especially on Wall Street. And so if we're talking to a fund manager, if I'm going into Fidelity and I'm talking to Tom Allen, I know Tom Allen for 25 years, small mid-cap guy, amazing. I can tell by the way his body language is and how he's looking at me, whether or not he thinks I'm full of shit, or he's there, or he's asking me a question about a stock because he's actually really scared about it, or he's actually really interested. That's how you find out about sentiment, not these stupid surveys, because they do not answer them. I'm telling you. So I think it's a bunch of shit. So, and with all due respect, Michael Hartnett, who I used to sit next to, and actually I replaced Michael Hartnett. He went up, the whole reason why I went to Merrill is he was head of wealth management strategy and they moved into global market strategy, and I took his job as head of
So
wealth.
if you don't believe in the fund manager survey, then you probably also ignore a lot of the bull bear AAII sentiment stuff as well, because that, if anything, that's probably even junkier junk science.
It is junkier. We've talked about this before. I've been blessed to be on your show for at least 4 times, and we talked about Bill O'Neill. And my very first mentor on Wall Street was William O'Neill, and from Investors Business Daily, God rest his soul. And he used to tell me, Belski, he said, there's always something going on. There's always news. There's always things making stocks go up and down, and don't get involved in the noise. And back in the early 90s, that stuff worked. So did put to call ratio. Put to call ratio was great, but you have so much focus on investors' intelligence. You have so much focus on the VIX. And so many people are building products around it. It's manipulated it now. So again, the best sentiment from my perspective is talking to clients, number one. But number two, we have models that we look at in terms of price performance. We do standard deviations and things like that. From an intra-sector type basis, that's how we try to measure volatility.
It's funny. We think this is like a noisy period. Uncertainty is heightened. It's never been this
always
crazy.
like that.
The S&P 500 is at an all-time high. Credit spreads are at an all-time low. The VIX is at 15. So what is this noise that we're hearing about?
I think I don't know. I mean, I have some theories about it. It kind of goes in backwards order. I mean, I think COVID really messed us up emotionally, and then before that, from the financial services side of things, it was the financial crisis, and then before that, even I'm talking about the tech wreck. I think since 1999, 2000, we've been so emotional in trying to. We're so afraid to be wrong. We don't want to be right. That's why analysts like the great Dan Ives, he had a dead period in the early 2000s. Why? Nobody trusted analysts. It was all quant. It was all do your own models. Now he's coming back because he's so awesome and he's been so right and he thinks thematically. But analysts and looking at bottoms-up research went away after the tech wreck. Then the financial crisis, we were even more worried. We're printing money. We have not seen a normalized market, which hopefully we get to talk about that. We have not seen a normalized market since the 1990s. We've been under duress and craziness since, I think, 2000.
I have two theories to add to that. You can throw both of these things on the pile, and different people would probably weight them differently. But here goes. Number one, the business model of the media changed around 99, 2000.
Yep.
When you were selling newspapers and magazines for subscriptions, pretty much the subscription money was going to come in no matter what, regardless of whether people opened the newspaper or left it on the driveway. It was subscription, and they had an ad business too, but the ad business wasn't as important. With the birth of the internet, now it's not about subscriptions. Now it's about people. A certain amount of people have to click every day. No matter what, if you run a media business, you must bring in eyeballs, which turns the reporters into carnival barkers and forces them to frame everything in such a way that somebody coming across the headline will click on it.
Yep.
That's a business model shift. It's a secular shift. And it's hard to imagine us ever going back to quote unquote normal markets like what we used to have, because everybody's in the attention business now. So for me, that's a big one. The second one is we had 50% bear market declines within 7 years. and nobody wanted to be caught bullish ahead of the third one. That hasn't come yet, but it's 15 years and counting. But when you go through a decade with 2 back-to-back 50% drawdowns, it's really hard to just say everything's normal, everything's fine. It almost seems like you're saying that and it's setting you up to get your head cut off. So I think that both of those two phenomena have produced this environment where we are, quote unquote, always on alert. What do you think?
No, I think that's spot on. It's directly correlated with what I was talking about. And if you think about the impact it's had on the actual investor in the United States, okay? I was at Piper Jaffray in 2000, where the average U.S. investor had 90% stocks, and 100% of them were tech. And so that really burned them for a long time. Then if you think about the emotional side of that, where we went through 9/11, we went through 2 recessions, we went through
Enron, WorldCom.
Yes, Lucent, all those JDS Uniphase and Selectron, all these things. But then we also went through the advent of the euro, where America didn't matter anymore. We were chasing the euro. We were going into emerging markets. Oil was hot. Canada was hot. China. And so,
is that a Maria Bartiromo impression?
Maybe.
Not bad.
Thank you.
What do you think about China?
What do you think about China? Anyway, so I think that was a big part of it. And then we lost credibility and hope for the financial services industry. I was at Merrill Lynch at the time when my blessed firm was involved with a hostile takeover by Bank of America, also known as the Evil Empire. And I was there during that time, and it was scary. I mean, that was scary because we didn't know what was going on. And then COVID. And so I think the emotional response to this, and now, given the fact that we're TikToking, this is how we read nowadays. We read like this. Okay, yeah.
We're in a post-literate society.
Yeah.
We're back to our oral traditions of 1,000 years ago.
Right, so that's where I'm going back to what I said before, to the Zers out there, man. To the Zers out there, learn how to write, not like this or not like this. Learn how to write and actually speak and look people in the eye and say hello and shake their hand and talk with them, because you will set yourself apart from anyone else.
Brian, you said markets were normal in the 90s. What is abnormal? Like, what feels so different about today versus that time period?
Well, the way that, today was a typical day, which is now normal with all these crazy reversals, and I'm sure we'll talk about it. But so BMO has learned, I like to say, that interest rates aren't going back to zero. Okay, the way that the Fed has operated since 2007 is not normal. The way that they printed money, the way that stocks in the markets have gone in these wild gyrations is not normal. We believe that normalcy looks like kind of a 95, 96 market, or an 84, 85 market, where you've got going back to the historical returns of, let's just keep it simple, stupid, 10% appreciation, put a little dividend on the market, 10% earnings growth, multiples somewhere between 18 and 22, which, oh, by the way, will be coming down because earnings are going to be coming up. We've had this whole transition of multiple expansion. Now it's going to be earnings growth and a trading range in the 10-year treasury. I hate it when fixed income people come on or they talk about equities. So I'm not going to talk. I'm not a bond person. I stay in my lane. But I think what needs to happen is some sort of a trading range, 100 basis point range, 350 to 450 in the 10-year treasury. That's a damn good backdrop to own equities.
We're there.
So I think this year we have jump-started normalization. Hear me out. The DeepSeek thing was a shot across the bow. The DeepSeek thing was a shot across the bow because people were buying NVIDIA for the wrong reasons. People were buying NVIDIA because it was going up. They didn't understand the fundamentals.
How could it be wrong when it feels so right?
So it only works until it doesn't work. I think that was a major thing, and they learned that. So I believe that is only going to exacerbate the spreading out, the broadening out into value, into dividend growth, into small cap, into mid cap, because they got their ass kicked. And now we're going to kind of go back into stocks that are actually working and earning fundamentally.
I want to talk about the bull case for America. And this is you. You say use a domestic focus to dilute the tariff noise. We have been bullish on America for quite some time and have developed many of our investment strategy opinions around this premise. We continue to believe the U.S. will be a main source of relative growth in the coming years. As such, we have been advocating that investors not only focus on U.S. stocks relative to other regions, but also focus on those stocks that derive a significant portion of revenue from domestic sources. And then you go on to talk about how you can kind of delineate between the two different buckets within the S&P 500. Share those thoughts with the audience and why you think that's so important for this year.
So here we are. Michael was talking about earlier. I tend to be on this program where there's these crossroads. And the crossroads recently has been, we've had this amazing news on Europe hitting new highs and China's working. And one talks about Alibaba. And you know what?
Not a fan.
You know what I think about that?
You're such a hater. I love it.
You know what I think about that? Whatever. I say, and Kurt Cobain said it best, whatever, never mind. And this is what I mean by that. So as you know, I probably told my Warren Buffett story before, but Warren Buffett said, don't ever buy anything unless you can reach out and touch it. I don't understand why anybody want to go anywhere else that buy companies outside the United States. That's number one. Number two, I think that there is going to be continued volatility around the world, fundamental volatility. And what do you do when you buy when you want to combat volatility? You buy quality. What's the best quality asset in the world? U.S. equities, period. And so everybody wanting to chase Europe because it's been a shitbag for a decade, that's great. Go for it. God bless you. I'll say hello to the Holy Father for you. But they're not making anything. They don't do anything. Go there for vacation. That's fantastic. With respect to China, China needs us more than we need China. That's a declining asset. They've been declining for 10 or 15 years. So I think the U.S. is the place to be. Now, from a distributive standpoint, I think we have the best franchises in the world. So from a fundamental perspective, you want to find that has the sweet spot in terms of valuation, earnings growth, and operating performance.
So, Brian, you break it down. This was interesting to me. You say that you break it down in terms of companies that get more or less than half of their revenue from inside the United States. And from, what is this? From the GFC to the onset of the pandemic, it was basically even.
Yep.
It was 16.3 versus 16.6. But from the pandemic to today, stocks that have more than half their revenue outside the United States have kicked the shit out at 19 versus 17, a big spread. Is this just a tech story or is there more to it?
A big part of it is the tech story.
Capsized too, though, right?
Capsized. And I think a lot of people are confused about why technology works sometimes, especially after this big run. And after bouts of volatility, guys, you'll notice that in the old days, you just buy the top 10 companies market cap wise because there's liquidity. Oh, by the way, what are the top 10 companies? They're tech stocks. I mean, there's something behind that in terms of a liquidity standpoint. People seek things that they can get in and out of from an equity perspective in terms of liquidity. It is a tech side of story. But I think the big kicker, though, again, you want to look forward. You don't want to look back. I think the big kicker in terms of earnings are going to be financials going forward. I think financial stocks remain undervalued. The analysts are
even with the rally last year.
Yes,
Okay.
If you talk to financial stock analysts, they're still pretty negative, and we haven't seen any kind of major banking cycle. That's why when you hear about we have an AI bubble, we can't have an AI bubble until we have all of these deals, either consolidation or IPOs, and we haven't seen this major wave of IPOs.
You know it's a bull market when Citigroup and Wells Fargo are at multi-year highs. So if DeepSeek was the first shot across the bow, and by the way, NVIDIA closed the gap, so that entire decline has been brought back. Let's just say that tech pauses or stalls or heaven forbid even has a sell-off, can the market continue to work without the giants?
I think it can because look what's happened in the Mag 7. The Mag 7 is comprised of three sectors, right? It's not all tech stocks. It's three sectors: technology, communication services, and consumer discretionary. We'll start at consumer discretionary. Our theory and our strategy for 2025 is barbell it, man. Barbell it. So on the Magnificent Seven properties within consumer discretionary, we're going to neutralize Amazon and Tesla, and we're going to overweight Lulu, Home Depot, TJ Maxx, Marriott. Why? Tracking error, and we can get better performance there. I think.
So just for people that aren't fully versed in portfolio construction, the way to neutralize Amazon and Tesla is to own less of them than the market cap weight and take the excess capital that you have and overweight some of the other large names in the basket And that way you're not making a bet on the highest priced securities in the sector.
Correct.
But you still get the upside of the sector.
Correct. And that's in our tactical stuff. Same thing within communication services. You've got the Netflix machine and the Google machine. I don't own any Meta, but those two on one side, and on the other side of the barbell, Spotify, which isn't in the index, so you already have a big tracking area there. Spotify is an amazing company, but you also have AT&T and names like Reddit and things like that. That's how you can gain tracking error there.
You're talking about tracking error positively. You want the tracking error.
I want tracking error because so we've talked in the business. They talk a lot about stock picking, right? When I go into institutional clients, I start talking about the golden age of stock picking and what I think stock picking is. The Gen Zers and the millennials, they look at me like these clouded eyes because they have no idea what I'm talking about. Can't I just buy an ETF and then that won't work?
Brian, watch your mouth.
What did you expect? Anyway, I'm here to speak the truth. But I think that I know that how you add value to a client is making a bet. Making a bet and believing in it and sticking with it and doing the homework. And that's how we've been able to outperform. That's why we bought Oracle 10 years ago. That's why we bought Palantir 2 years ago. That's why we bought NVIDIA in 2019. That's why we bought Netflix in 2014, just because I believed in it and I just kept on adding it and moving it around as
Spotify is an amazing example of what you're talking about with tracking error. So what is it, 200 billion yet?
Yeah, I bought Spotify and put it in my SMID portfolio when it was $30 billion.
But what's so great about it is because it's not in the S&P 500, because it's a Scandinavian company, 100% of the upside is pure alpha. It's not in the index. So and you ask, why do people bother with Alibaba? Same thing. If you're a hedge fund and you need a big liquid stock and you want to drive pure alpha that's not part of the beta portion, you can do that with only a few international stocks that move like that. So Spotify has been a great tool to be able to do that.
Spotify, I'm in love with Apple. Love Apple. One of my really good friends in the business named Gene Munster. He was the axe on Apple early on at Piper Jaffray in the early 2000s. Like, Belski, you're not getting it. It's about the operating system. Because I would say, I got a Dell Music Match. It sounds great. He's like, Belski, you're not listening to me. It's about the operating system. Then finally, I'm like, okay, I got it. And I've owned Apple ever since. But going back to Spotify has a better product when it comes to music. You have better music. You can mix the songs together. You can, there's no, space in between.
Show of hands, how many people listen to this show on Spotify?
Wow.
It's more than half.
Wow.
And Spotify lets us upload the video concurrent with the audio now, which we started doing 2 weeks ago, which is like the new thing in podcasting. Apple does not provide that. They're behind the curve.
Brian, you mentioned, you're throwing out a lot of names. TJ Maxx, Lulu, Home Depot, AT&T, Reddit. How does the work get incorporated into your system? Are you leaning on the analysts? Like, what exactly are you looking at to say, I want to buy that, I want to sell this?
It's a wonderful question. So we published this book and have since 1998. It's called Chart Book. And in the chart book, we have 4 pages of information, 4 sections for every sector. And then we have in the background, the spreadsheets on the industries and obviously the market. And so the 4 sheets are valuation, earnings growth, operating performance, and price performance. So that's how we make a lot of our sector decisions in terms of adding all that up together. And then we layer that into stocks. And so, for instance, the reason why we've owned Apple all these years is just because of price to free cash flow and earnings discernibility, meaning consistency of earnings of Apple have just been amazing. So it scores high off that. But we also have all of these different screening mechanisms through FactSet or CompuStat and all this kind of thing. But being that I'm the Doogie Howser of Wall Street. I've been in the business 35 years. I started when I was 7, by the way, ladies and gentlemen. I know a lot of people. And if I don't have an analyst that covers it at BMO, I call them up. And so I lean on a lot of cool people, one of which I've already named, Dan Ives, who's a very good friend, known him for a long, long, long time. And he's the one that that convinced me to stick with Tesla.
I know it's a science, not an art, but when you think about things like I don't know, fundamentals, free cash flow versus valuation. So Apple, for example, not even specific to them, but I guess in this case, specific to them, the fundamentals aren't great. There was a lot of valuation expansion last year. So how do you think about that? Again, it doesn't have to be Apple specifically, but how do you, like, what supersedes what? What's the most important part of your story? Does it depend on the sector, the stock, the market, the interest rates?
If you were just going by earnings growth, you would not love Apple.
Yeah, so here's the way I think about it. I think about Mrs. Thompson in Wilmer, Minnesota, where I grew up. And I think about Mrs. Thompson I'm not going to be
Your first love?
My first love. She broke my heart.
Was she your Veronica Vaughn?
She was Veronica Vaughn. That was an obscure Billy Madison. I have the microphone, so you will listen to me if we're doing Adam Sandler quotes. Anyway, I think about her, about why would I sell Apple if Apple's one of the best companies in the world? If I'm trying to limit turnover to 22%, that's really low turnover, ladies and gentlemen, where the majority of portfolio managers in the 150% turnover.
22% is extraordinarily low.
Yes.
Okay.
So in, like, for instance, in tech, I can hold Apple at a market weight position where I can underweight NVIDIA. Why would I underweight NVIDIA? Because I can't possibly keep up with the market cap changes. It's too volatile. But Apple I can, because Apple's a stock I want to own until something fundamentally, operationally changes. Oh, by the way, that's why I buy companies too, because they've fundamentally broken or operationally broken, and I put them in my value portfolio. So I look at the overall thematics everywhere from company leadership to background to how they make it and their earnings. And it doesn't have to be every stock does not have to be a home run, and everything doesn't have to be working all the time. That's why you have a portfolio.
When you decide that something is fundamentally broken with one of your stocks, do you sell slowly just in case you're wrong and price continues to prove you wrong? And then you say, all right, we got out of a third of the position, but this thing is still running and maybe I'm not sure. Or do you exit and you go from one quarter to the next, you own it, you don't own it, period? What's your methodology?
It's a great question. So
I'm very good at this.
You're very good. If I have a company that lies to me on a quarterly conference call where they were up in the numbers, talking the numbers up, and then they lie, sell the stock right away. Because I have to be able to trust them, and I'll put them in the penalty box.
And you don't care what happens after?
I don't care. Guess what?
So you will take a position from 2% weight in a portfolio to zero in that moment.
And I will, but I'll do the opposite too. So one of the best stories over the last 12 months was Starbucks. Okay. I'm sitting there with my team, and for some reason we had the stupid channel I'm on, CNBC. I'm sorry, CNBC was on, and
best channel in the world,
best channel in the world ever. And I watched this interview with the CEO of Starbucks, and I looked at my team. I said, "This guy's getting fired. He's getting fired."
I remember the day too. I know exactly which interview you're talking about.
Okay, he was talking about, and I'm like,
I was watching it.
I'm like, dude, why are you talking about $9 mango teas, man? We can't afford those. I said, this guy's getting fired. So I said, guess what? We're going to initiate a 200 basis point position, which is a big position for a brand new position in our value portfolio. And so my team's like, what, Belski, you're nuts. I said, this guy's getting fired.
The stock's in free fall. It's coming from 100 to 70.
I bought it the same day. Let's go.
Right?
Yeah.
So I bought it, and then what happened? Was it literally 6 weeks later?
Maybe not even. Yeah.
They did
you got almost instant gratification.
Baller move. They did the baller move by getting the dude from
They
Chipotle.
traded for Luka.
Yeah, they traded for Luka.
They did. They got Luka.
And so that's a different strategy though, right? You want to be a little bit contrarian and think differently. But on the opposite side, I will sell a stock if somebody lies to me, or in our more disciplined, formulaic side, especially dividend growth, where we will sell a stock if they cut the dividend. If they cut the dividend,
what's the worst sale you've made in the last 5 or 10 years that you can think of, where you just say to yourself, I can't believe I'm not in this stock?
Meta. And I bought
same.
Yeah, I sold Meta, and it from an operational standpoint. If you remember, he was talking about the metaverse. We don't need to be in a WhatsApp or Instagram or Facebook because it's boring business. We're going to go to the metaverse. I said, what? Because of the metaverse. So I'm like, I'm out. I sold it. Yeah. And then during the vid, he comes back and goes, we're going to focus on our legacy businesses of WhatsApp, Instagram, and Facebook. I'm like, this guy doesn't know what he's doing. And I said, you know what, from a correlation standpoint, what does that mean? How does the stock trade fundamentally in terms of earnings and valuation, but more importantly, price performance relative to Google? Well, it's pretty much the same at that point it was. I'm like, okay, guess what? I'm just putting all my meta stock into Google. And it's worked out okay.
Brian, do you need to have a strong view on the future of AI, given it's like the dominant theme in markets today to manage a portfolio?
Yes and no. Obviously, I'm just a simple kid from Minnesota. I know exactly about AI. I call really smart people like Dan, and I have them explain it to me, like I'm 4 years old. And I spent 2 hours on the phone with Dan on Sunday night when the whole DeepSeek thing, and he calmed me down. But I mean, I think some of the greatest AI stocks aren't even technology stocks. They're Costco and Walmart. And
So you believe the efficiency gain story?
1,000%.
The beneficiaries of AI.
So 1,000%, say more.
I just think that if you think about what AI is doing, and you think some of the banks were very, very early adopters and huge investors in fintech, which ultimately became big parts of AI. I mean, we're going to be able to walk into a branch anywhere here in the country, and the ATM or the teller is going to know what language you speak. That's all through AI. Think about that. So it's these types of things I don't think anybody thinks about. Obviously, we think about walking into McDonald's and what kind of hamburger you want and Shake Shack and all that. But
you pointed at me, Shake Shack.
Because
I wasn't there today.
no, but it's one of your favorites. By the way, you talked about earlier about why we buy stocks. So I really challenged my team. I said, what are people buying now? Where are the Zers and the millennials? How are they spending their money? It's experiential still, right? And that's what got us in Reddit. That's what kept us in Reddit. That's how we went into Shake Shack, because I think they want it. They want the experience. I think Shake Shack is to the Zers what Chipotle was to
Millennials.
the millennials.
I think so too. That's my actual thesis.
And my son went to the University of Nebraska, and his apartment was on top of a Chipotle. And just let me tell you something. That kid spent a lot of money at Chipotle after 3 o'clock in the morning, 3 or 4 nights a week.
You mentioned that Dan Ives calmed you down on Tesla. I want to ask you just broadly on Tesla. What do you do when a paradigm-breaking company like that comes along? There's no way it fits neatly into any of the traditional models that you've ever looked at.
Nope.
It doesn't make sense as an auto manufacturer. Even if you say this is innovation tech, from a fundamental standpoint, 5 years ago, it looks like it's going bankrupt. Of course, you have no way to know that he's going to become the right-hand man of the eventual president. Like, none of those things are possible to predict. How do you have a research process? And then also, oh, by the way, we're long Tesla. What's the magic ingredient that you have to see that enables you to pull the trigger on a long situation like that?
Well, we default to the process, which Tesla doesn't fit any of those processes. That's number one, as you said. Number two, I have these amazing resources. And what do I say about, how do you diffuse volatility through faith, and what's faith in our business fundamentals? I mean, he's the Albert Einstein of our generation. He is. I don't understand him. I think he might be nuts. But at the end of the day, what he's been able to do with all these different companies. So I had an amazing dinner with Danny Ives and a really, really great friend of mine, Nancy Tangler, who is one of the top 10 people I've ever met on Wall Street. She's amazing. We're having this dinner, and I'm like, Danny, I said, prove to me that the crazy narcissist Musk can actually, nobody caught that? He can actually do all of these things. Okay? He's like, Belski, man, you don't get it, man. You don't get it. I said, what don't I get, man? He said, this is Dan. I'm not doing a really good Dan Ives. But he said, the AI. Belski, man, he's passionate. He's been passionate my entire life. I've known him for 20 years. He's passionate about cutting costs. I said, what are you talking about? I said, even when I was first going in and talking to Tesla, he has had spreadsheets and working on cutting costs in the United States government. He's been thinking about this.
Is that true?
That's what Dan Ives told me.
He was passionate about the United States government's budget?
Yes.
Really?
Yes.
Okay. Maybe there's more than meets the eye for all of us.
That's what I'm thinking. I'm like, okay. But, going back to my thesis, right? So if your barbell consumer discretionary, which it's in, which is ridiculous, right? Like Ubers and industrials, ridiculous. But we bought it. Uber because you can take advantage of that. Anyway, so if you neutralize, you can be overweight Amazon, right, and be underweight Tesla, and be neutral that part of the Magnificent Seven, and then you overweight Lulu and Marriott and Home Depot. And
Are you long Uber?
I am.
Okay, me too. That's my biggest conviction long.
I bought it 2 months before I got into the index.
Okay.
3 months last year.
So give me some copium. The stock is not at an all-time high. It's close.
Copium, it's working.
It's 79. I think it should be 100. I think it should be 100 to 120. I think the discount there is coming from fear about Waymo
Driverless, yeah.
at Google and the cyber taxi from Tesla.
Yep.
The stock was on its way, and then the cyber cab announcement hit in April, and it hasn't been the same. How do you think about competitive threats in disruptive industries? And because to me, it looks like Uber has 50, 60% market share. And people think like magically overnight, everyone's going to be in an autonomous taxi. And it's just hard for me to picture.
Well, that speaks to the reactionary mode that we are in terms of investing, the binary, red, green, yes, no,
love it,
Republican,
hate it,
Democrat,
right.
whatever. What are we? And so we're going to react to everything. I think Uber's market share actually only increases because it's the better company, number one. Number two, if you are an S&P 500 or Russell 1000, which are the proper indices for if you're running large cap money in the United States of America, if you're walking into Fidelity and their benchmark against the S&P 500 and they have to be neutral, the industrial sector, right? What is that portfolio manager buying now? What is he buying? He's worried about Lockheed Martin. He's worried about Waste Management. What are you going to do with Boeing, right? And then you got Uber. So now Uber is in the S&P 500 industrial sector. So he can't be naked, quote unquote, naked that sector or that stock. So he's got to buy it.
Yeah.
So there's some implicit demand there. We got ahead of that because we kind of felt like it was going to get in the index, but the stock was just terrible in the summer of 2024, if you remember. So, but at the end of the day, we're going to buy it because I think its market share goes up. I'm not going to overreact to what's happening with driverless cars and all that stuff. I think Uber's a really great company.
You mentioned that if a CEO lies to you or to the people they're speaking to on a conference call, you're an automatic sell. I would not put Alex Karp at Palantir in that category, but I think he did surprise investors by announcing a larger insider selling program for him to get liquid on his own stock. By the way, from my perspective, with good reason, that stock has just gone up, 5x. Who wouldn't want to sell, some stuff? How do you think about situations like a Palantir where you've obviously made a ton of money? You were very early to the name. Now I don't want to say controversial, but now all of a sudden it's become a plaything of the bulls versus the bears and extremely volatile this week.
I go back to the product. They've got a great product in terms of the software side of the AI and putting that together, number one. Number two, in terms of the defense stuff that came across, that the defense budget's going to be cut. We don't know exactly where they're going to cut.
Yeah.
And I would venture to, and again, in classic Wall Street, sell it.
Yeah.
We don't know, so sell it. It's just like the guy, the CEO from Lockheed was on today. I don't know why our contracts aren't going down. And so I think that's been an overreaction. But I do think
sell first, ask questions
exactly
later is the mentality.
I think he's a transformational CEO with a fantastic product, and we can live with this volatility. And we're sticking with the stock.
Brian, I know you're not an economist.
No,
you're not a bond guy,
no.
but you are a strategist, and you do manage models. In 2022, especially, it was all about inflation and interest rates. And I'm really happy that story's behind this. But
Yes.
It was the fear of inflation and rising interest rates that killed growth stocks. But now, interest rates have settled in at around the same spot as they were when these stocks were getting killed. The companies have rebounded. Why do you think it is, or what do you make of the fact that these businesses are no longer bothered, or these investors are no longer bothered by competition for interest rates?
Well, I think, in the very beginning, we talked about our original call, talking about the 25-year secular bull market. You did a great job.
Starting when, by the way?
2009.
We'll allow
Not bad.
We'll allow it.
We'll allow it.
Thank you. But nobody really talks about the impact of the 40-year secular bull market in bonds. And we had that year 2022 where both stocks and bonds were down together. And then we've heard a lot about the death of 60-40, and a lot of investors lost money in bonds. And I think that I think we need to kind of think about, over the last 40 years, the majority of total return in fixed income vehicles was in price performance, Mike. It wasn't in yield.
Yeah.
I think we're going back into a period where we're going to have a combination. You're going to get more performance from yield. You're going to be much more diversified. And so I don't think people talk about enough the destruction that the bond market did. Needless to say, I think just like everything else, if we're yes, no, green, red, walk, run, doing this all the time, I think a more flattish, normalized environment will be actually good for fixed income and equity.
I want to not rehash, but we had a mini debate about high dividend versus dividend growth. And you
on
were
television.
On television. But we weren't really arguing. We were talking past each other because
Yeah.
I actually agreed with the point that you made. Break down for us why focusing a portfolio selection process on dividend growers versus which stocks are paying the highest nominal yield today is so important for outperformance. Why is dividend growth your focus versus high dividend?
Well, sometimes companies are paying high dividends because they're not growing at all anymore. And part of our whole process that we've talked about for decades is that there's three parts to a portfolio when how we run a dividend growth portfolio. The largest part of the portfolio is what we call dividend aristocrats, that are a subset of companies that have never cut the dividend for at least the last 20 to 25 years, that have free cash flow yields above the dividend yields, because you have to be able to facilitate the dividend, meaning pay the dividend, has positive earnings, okay, and a yield above the market.
So smallish.
No, well, that's a great point. That's a great question. We, in the beginning stages at BMO, we couldn't buy any financials. Why couldn't we buy financials? Because they cut the dividend during TARP. They couldn't pay dividends.
They had to.
So a couple of the only companies in the financial services sector that we could own, Ameriprise and BlackRock.
Okay.
Right? And so it took a while to get the banks going in there. And so that's the biggest part of the portfolio. Then you get a little juice in there in terms of high yield. We want to try to buy companies that do pay a higher yield, like an AT&T or Verizon, 3, 4, 5% yield. Maybe they don't have the earnings growth, but they have the yield in. Then finally, where the kicker is, you try to find those companies that are either beginning to initiate a dividend or really accelerating the dividend. And oh, by the way, there's some tech stocks in there. There's Microsoft and Apple. Who would have ever thought those names would be dividend growth names, but they are.
You have some really great points about this in some of your recent research. Investing in consistent dividend growers has been a favorable long-term strategy. Increasing interest rates do not hinder returns of dividend growth strategies. That's a big misnomer I think people have. You have found that is not the case. You also point out dividend growth stocks can help mitigate losses, but also participate in market strength. So this is playing offense and defense simultaneously, which I think is sort of a lost art in the markets. Dividend growth has a diverse sector composition with a strong cyclical tilt.
Yep.
So a lot of people think of dividends and they think, oh, it's too defensive, it's utilities. So you're talking about how dividend growth is not necessarily that.
What even are cyclicals these days? Like, the economy's not cyclical anymore.
Well, I mean, I grew up in the days that financials were cyclical, but they're not as much anymore. But it's parts of consumer discretionary, cyclical, industrials, energy would be thrown in there. Materials are cyclical, and there are some dividend names in there. But from our perspective, the biggest parts of where dividend growth is coming from are actually financials and technology.
Right. You've pointed out, if you look at rolling 1-year monthly returns since 1990, in which the S&P 500 registered gains of 10% or more, dividend growth stocks actually eclipsed the broader market by 4.4 percentage points on average. So in bull markets, dividend growth stocks don't hold you back. They may not be the most exciting AI companies, but you've actually outperformed bull markets tilting toward dividend growth, which I would guess most people would not think would be the case, having not seen your work.
They don't. And we have the good fortune of running 2 dividend growth portfolios for BMO. One's a North American dividend growth portfolio, which has Canadian companies in there, which traditionally pay higher yields. So we get even more torque there. But our U.S. dividend growth portfolio also outperformed last year in a year that was just amazing for the overall market.
What's the case for Canadian stocks?
Big game at 8 o'clock, I'll tell you then.
Well, I know. So BMO is obviously a Canadian domiciled bank, and many of the clients of the bank, both individuals and institutions, they are Canadian. And of course, it's not just home country bias. You tend to want to invest in things that you know, and you guys cover Canadian stocks extensively.
Right.
What do you tell someone who's not Canadian why they should or should not consider Canadian stocks as a diversifier for their own portfolios?
Very big picture, a couple things. From a management perspective, I think in a lot of ways, corporate managements in Canada are better than in the US because they think of really long term, especially in the financial services industry. Now they're cheap as hell, the banks, but they're amazingly run. They're excellent stewards of capital. From the second thing is that a lot of people don't understand that 90% of the Canadian population lives within 100 miles of the US. And there's a lot of stuff going around.
Which is why we need the wall.
We need the wall. Everybody here from Naples?
Yes.
Okay.
Yes.
All right. So you're driving down Immokalee, right? From 41, and before you hit the freeway on the right-hand side, there's a Circle K, right? Do you know that's a Canadian company? No? Oh.
Boycott.
No. So they have these amazing companies that the majority of revenues are here in the U.S. So it's Couche-Tard, it's Waste Connections, it's the rails, some of the banks, Shopify. I mean, Shopify is an amazing company. It's the portal for small mid-cap companies. But the day that Trumpy was talking about all the tariffs, right, February 2nd, I'm in Minnesota for a family function, and I purposely did not turn my BMO phone on because I knew all hell was going to break loose. So I get on the airplane, man, and I have 50 emails. Belski, you got to write a report. You got to write a report. When
Defend our honor?
Yes. So it's like, when someone's relying on me to be the voice of reason, no. Anyway, I was up till midnight writing this piece, and I said, listen, control what you can control. Control what you can control. There's a bunch of amazing companies in Canada, and I said this in print, quote unquote, that can, will, and should outperform the market. Canadians were acting like that day, February 3rd, was the start of the recession. So I knew that. So I had this cool chart that showed the average recession, the last 10 recessions in Canada, from the start of the recession to the next 6 months, the average market drawdown's 4%. There was stuff floating around the press that the market was going to open down 8%, open down 10%. People were freaked out. Now, with all due respect, Canada is a fearful nation. They take everything very literal. They're very serious. I coined this phrase about 10 years ago. I believe the average Canadian investor is the moral equivalent of the mythical creature Eeyore because, it's snowing. I mean,
this is going to air, right?
I know it is. And they know, by the way, and I love them. I love the Canadians. I love them. And I had one of the best client conversations I've ever had was with a Canadian private client here in Naples at Baleen when my portfolio that she owned was down 15% in May of 2022. It was an amazing conversation. Anyway, so the Canadians are scared, and we came in and said, just control what you can control, man. It's going to be okay. We don't know. We don't know what's going to happen. So this is how you do it. So what ended up, the market was down. It was down originally 5% in the open, and it closed only down 1%.
No big deal. So, Brian, you've got a price target for the S&P, at least at the end of January, of 6,700, about 9-10% higher. What are you worried about? I know you're still bullish, but and
by the way, you're not the most bullish anymore. You were, and you were right, but your colleagues, many of them have now higher price targets.
Yeah, what the is your problem?
Yeah.
What the is going on? So we were doing Adam Sandler earlier, so let's do a little Will Ferrell. If you ain't first, you're last.
Right.
So I was the first to put my forecast out, and I put it out a week after the election. And I do that every election year because people are obviously freaked out, they're emotional. So So we were early on the 6,700 and 275, which I think the 275 number is too low, by the way.
275 in earnings for the S&P this year.
Yes.
Okay.
And so we wrote in the report, we reserve the right to change our opinion, meaning I think we there's a possibility that we up this thing, but we'll see how that goes. But at the end of the day, we've had this. People know that we've had this long-term call, and I don't like making weekly calls in the market or monthly calls in the market. A lot of my competitors love to do that stuff. I'm not that smart. So with much humility, I'll stick with our 6,700 for now, 275, which is really a higher number.
You got to feel good about that 275 given what the earnings reports were for Q4. And I guess we're now 85% through those reports. I know NVIDIA is the big one out there still. Next week, you got Berkshire as well.
Yep.
And a few other big ones. But the 275 has to feel safer now than it did on December 31st, given what we have, 16%, 15% earnings growth so far?
It does. So we had this chart in our year ahead piece that shows the Magnificent Seven earnings growth kind of peaking and rolling over for the forecast, but the other 493 stocks in terms of their earnings growth just accelerating.
Yeah.
Right? And that's like, okay, guess what? We're going to be a stock picker. Let's barbell this thing. We will continue to ride the waves of the Magnificent Seven. But, oh, by the way, we're going to diffuse and dilute our risk a little bit by owning some of these other names.
So back to Michael's original question.
What scares me?
What is the
let me
one
just
thing
set
that
this
you're
up. So
most concerned with?
You're a big, there's cyclical bears, right? There always are within a secular bull. Even a 20% decline from today, that would take us back to January 24 or 23. So nobody wants to see that, but would that be like the end of the world if we were to get some sort of a reset in this?
It'll feel that way.
It'll feel like shit, of course. I know. I get
It'll
it.
feel that way. So I think that, can we get a 10% drawdown? Yeah, I think we can. And actually, I never like to say, I don't like when stocks go down. I don't like when people lose money. But we need to shake out something a little bit. And that would create the next, I think, great buying opportunity for this bull market, which I still think has a ways to go.
We need a wall of worry.
We need my
What is it? Is it tariffs for you? Is it inflation?
It's something.
Is it tech earnings?
It's not tech earnings. I think it's going to be the inflation side of things. People not understanding that maybe we're not going to get back to 2%, what that means, and
Well, we're not.
No,
Like,
we're not.
Spoiler, we aren't.
The compound has learned that we're not going back to 2%.
Well, if we do, it's really bad news. There's a really bad reason for us getting that,
right?
Because it seems stickier than we thought it would be, but it also seems to be in a little bit of a stasis.
Right. I don't need the Fed to do this. I don't really care about the whole interest rate side of things because the Fed funds futures thing has been so wrong for 2 years. And it drives me crazy when people talk too much about it. You know what I'm really happy about? That we've not said the word momentum.
Okay.
A lot.
Well, now you did.
I know. So if
Let
anybody
the cat out of the bag.
have you
now.
ever seen the movie Elf? And there's that classic line in Elf. Call me Elf one more time.
Yeah.
You feeling tough?
Yeah.
You feeling strong?
I'm so sick and tired of momentum stock. Oh my gosh! You know
But
that
why? What's the problem?
because you don't buy. We went back to deep sea. You don't buy stocks as they're going up. You buy them because they're working fundamentally. If you go back, we do this really cool report called the Factor Profile Report. We go back 57 investment factors, and we measure the performance of these factors since 1990. You know the number one factor in the United States stock market since 1990?
EPS growth?
Wait, let me try to guess it. The number one, like the investment factor to overweight that would have beat everything else?
Yes.
Momentum.
No, it's not even the top 10.
Oh, I'll fucking leave then. I don't
See you later. It's
Do
low
I get a
price.
do-over? Low price? What do you mean low price?
If you buy the 25 lowest price stocks in the S&P 500, you buy them in the first day of the month, and you sell them the last day of the month, and you read
Low price? What do you mean by low price?
like the $10 stock verers
low
the 20?
price. Yes.
Come
No.
on.
Yes. You know the number two?
Don't tell this audience that they'll be buying dollar stocks. Don't do that.
The compound annual growth rate of that strategy is 25%.
So why don't more people run that strategy? Because it's like embarrassing.
Because it's
insane.
It's insane. But also price to free cash flow and enterprise value to EBITDA. You don't find momentum until like number 25, 26, 27. And the very worst of the 57 investment factors that we look at.
Momentum.
No.
All right, thank God. Thank God.
Estimate dispersion, meaning the analysts that cover all these stocks, we measure all their earnings estimates, and the wider the dispersion, meaning the wider range of the numbers. If you buy those companies with a really wide range of numbers, you're gonna lose
There's
them
not
all.
57 factors. What's one of them? Companies that start with the letter F?
No, there's
Come on.
No, there's a lot, dude.
Are you kidding me? So you can go everywhere from 1 month percentage versus 3 month percentage to earnings. You can come
I can
up
get
with
you
10.
a toe, dude.
I can give you like 15
Yeah,
earnings
you're
growth.
told by 3 o'clock this afternoon. Last thing we got to get to. I mentioned it. NVIDIA is obviously looming large in the minds of everyone, whether they own it or not. It is the bellwether stock. There are people now throwing earnings watch parties at bars in Manhattan. I have not been to one of these, but this is a very big part of the expected earnings growth for the S&P in 2025. Yet again, it's the second largest market cap in the market, or the largest.
Depending on what day it is.
So they'll report on Wednesday, and I expect obviously a lot of media attention on that number. How do you think a good number will be? Is there a number good enough they could report that won't be a disappointment to some? And what happens to the broader market in the event of an actual disappointment?
Blow up. That's
And what is your price target by the end of that day?
on the S&P? I might be revising. No, I think it's about the.
You agree that there's going to be a lot of commotion around whatever that report is,
it's
right?
Going to be
Okay.
it's going to be widely speculated. I think it's all about what he's going to talk about revenue growth. I think that's going to really be the key thing.
The Q&A,
I really believe that.
the guidance.
Yep. I think the guidance and the revenue growth thing is going to be a really, really big deal. And maybe he does a Kevin Bacon and Animal House, Remain Calm, all as well.
I thought you said
let's just-
Footloose.
No, I'm not going to do that. Just slow down. Everything's going to be okay. I mean, when you have the best product, I mean, you can act like that. And so I think it's going to be all about the guidance and what that reads out for the next 3 or 4 quarters.
Ladies and gentlemen, Brian Belski. So we like to end the show by asking our guests what they are most excited for or looking forward to in the future. And so we won't do NVIDIA again. But what's something? It could be personal. It could be business. It could be anything. What are you excited about? What are you most looking forward to?
I just got done watching Landman. I highly recommend that.
So good.
Great
So
show.
good.
I think it's the best show of last year.
Better
I'd
than
say.
Yellowstone, I would say
Yeah.
that. I'm looking forward. Here's a little on a personal note. So I'm a grandfather, believe it or not.
You're not going to say the Blue Martini
No.
tonight. All right.
And so I'm known as.
I don't know where this is going.
I'm known as Pops, because I told when my daughter told me she was pregnant, she says, "Daddy," she said, "you get first dibs on what you want to be called, because my ex-wife's remarried and they've got all these other current dads and stuff around." I said, I don't mean to be vain or anything, but do I look like a grandpa? I said, we're going with Pops. And so my grandson, I'm looking forward to my grandson turning 1. And so it's going to be amazing.
Very wholesome.
And he's a monster. He's 26 pounds. He's an amazing, and I'm so blessed to have him in my life. So that's what I'm looking forward to.
Has he said the word Pops yet?
So he was here for just over Christmas, and I'm literally, I let my daughter just go lay in the sun, and his dad go do whatever, and I'm taking him for walks. I'm like, pop, 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 pop. Come on, man.
Trying to manifest it.
And I get to go home and back to Minnesota next week and take care of him for a couple days. So I'm really excited for that.
All right, Michael, would you like to try to top that?
I'm just looking forward to getting home. It's been gone for a week. It's too much already.
You've been here for a long time. All right. Michael Batnick, ladies and gentlemen.
Thank you.
And before I tell you what I'm looking forward to, I want to acknowledge the crew that makes all of this possible, and not just today, but every week, all of the shows that we record, we film, we edit, we publish. They are, honestly, there is no one working in financial media that is capable of doing what this crew does, and I want to acknowledge them individually. Ladies and gentlemen, Miss Nicole. Big John. I think Duncan is somewhere in the rafters.
right here.
Oh, we have him here? Get up here. Where are you hiding?
He's our Soderbergh.
Get up here. Wave hello. They can't see you. They can't see you. Give it up for Duncan Hill. And the troop leader, Rob Passarella, ladies and gentlemen. And they love you so much. I want everyone in the audience here live, but also everyone watching. They love you so much. We love you. They love you. They think about every detail. If we're late with a show, It bothers them. They never want to put something out that's substandard. They edit late into the night to get this right. They really care about you. And you guys coming out to this really makes them feel like that love is reciprocal. So one more time.
Thank you.
And I want you to know what I am most looking forward to is continuing this show for all of you. We get incredible feedback from you guys throughout the course of the year. I know it's helping you become better investors. I know it's helping you feel better when we're going through market corrections, that we're going to get out to the other side of this. I know that what we're doing is important. It's not just something that you throw on when you're riding a bike or whatever. I know it's meaningful in all your lives. And so the thing that I am most looking forward to is doing this with you guys, like the video said before, forever. Round of applause. Thank you so much. Guys, we appreciate you. And anyone that wants to come say hello, we'll figure out a way to do that, because I know many of you traveled to be here, and I want to get a chance to say hi and say thank you in person. So, all right, on behalf of all of us here at the Compound and Friends, that's a wrap. We love you, Naples. Thank you so much for coming out. We'll see you soon.